Let's start with Workday. What did you make of the CEO shuffle?
Yeah, look, I think a couple things are going on here. Number one is, Carl was brought in with a lot of fanfare, and I think he did a lot of great things in terms of building out the partner ecosystem, some of the go-to-market stuff. But I think there was recognition within the company. Number one, that growth had continued to decelerate, and you've seen that kind of show up in the stock price performance and some of the long-term targets continuing to have to be brought down. But I think there was also this, well, AI is shifting things at an exponential rate. And there was almost this perspective of, we need to bring the founder back in. We need to bring a technologist to do things. And that's increasingly kind of a thesis I think we're dealing with is this the time where you need technologists to kind of step back in to make sure these companies can invest in the right areas in AI and, cross the chasm in this post AI world, so to speak.
So, are you expecting more CEO changes in the software sector? We've seen the carnage, and I want to talk to you about it and what you make of it all. But broadly speaking, I'm sort of trying to think. Snowflake got ahead of this early, right? They brought in Sridhar, and he was obviously from Neva. He had the AI expertise. That was before all these software stocks started tumbling, although Snowflake had been on a bit of a journey itself. Are you expecting more of these CEO changes to come?
I would expect more of this. I mean, we saw that happen with MongoDB. I thought David Tiacciari was a fantastic CEO, but they brought in CJ Desai to accelerate,
Yeah.
specific initiatives. So they did that too. And in the middle of all of this, right? I mean, thankfully the stock had already been recovering under Dave, and I think CJ can maybe take it to another level. I wouldn't be surprised to see more of these CEO changes, happen with the recognition that this is unprecedented times that we're navigating through, and sometimes you need a new leader to be able to navigate that. Like, could Adobe have migrated to the cloud without Shantanu? Could Microsoft have undergone their cloud migration without Satya? Maybe not. Maybe not as successfully as they did.
Okay, so who are you watching then for these changes? I'm looking at your coverage list here. I mean, you got all the big names under your belt. Who are you watching?
Yeah, look, candidly, I know this is going to sound like a cop out, but I'm watching any company that is not founder led, right? That's where I think there's probably the biggest opportunities, because a founder, led companies, if anything, I think that, like we saw with Workday, they're kind of stepping back in, managing the roadmap, taking the long term perspective. So I think it's the companies that maybe aren't founder led where there may be those opportunities. There's no specific names out there, but I would say non-founder led companies that have had massive underperformance in their stocks are probably going to be the ones where I think you're most likely going to see a CEO change happen.
Okay, so let's talk briefly about Monday.com. There was another name that dropped more than 20% yesterday. What did you make of the story there?
Yeah, look, I think, and candidly, I don't cover Monday.com, but I pay attention to it, and cover some of their competitors as well. Look, I think it's showing us, and I would combine that along with Zoom Info reported yesterday. Their stock's down, double digits this morning as well. It's telling us that no matter how cheap any of these stocks are, if a company guides below where published consensus is, and the general viewpoint is published consensus is a conservative number and should be beatable, if you are guiding below that number, it's kind of almost a death sentence for the stock. And I think we saw that play out with Monday.com. I think we're seeing that play out with Zoom Info this morning, that you cannot guide below that. And candidly, like even an above market guide may not be enough, as we saw with Microsoft and ServiceNow. And candidly, I think public companies are in a very tricky situation where they can't guide so conservatively that their stocks get whacked because it starts to feed the AI bear cases. But if they guide too aggressively, no one's going to believe those numbers. And then if they do end up hitting them, they won't get credit because it's already in the guidance. So it's a really tricky balancing act that we're, I think, going to deal with this upcoming Q4 earnings season, both on and off cycle.
So let's go past the earnings for a minute. Let's talk about the valuations broadly. Look, there's always been a bit of a seesaw here. Are investors valuing growth? Are they valuing profitability? Which one of those is more important at any given moment? You're at a point now where I think the median software company is trading something like 3 to 4 times sales, and that is a number we haven't really seen in a long time. But my question for you is, where are we in that valuing growth versus valuing profitability story? Is there more weight put on profitability today? Because some of the most profitable companies are still getting traded down.
Yeah, it's an interesting question, and very timely one. We actually just published a note on this exact topic. But you are seeing some of these names pull back to the point that you can value them at basically market gap price to earnings ratio. I don't know that I've ever seen this play out in software before. It's very much unprecedented times. And what's interesting is, in contrast to previous SaaS drawdowns that we've seen, like 2016 or the kind of post-COVID cloud rationalization era, numbers in general are not coming down, right? Putting aside cases like Monday and ZoomInfo, but like my numbers for Microsoft went up post that quarter in spite of the drawdown in the stock. My colleague who covers ServiceNow, his numbers went up for ServiceNow in spite of the drawdown in that stock. And I think it's telling us this is all terminal value risk. And if you really do the long term math on some of these names, they're being valued at with negative terminal value, which
Hmm.
in other words, it's saying that this company is being valued today as if it's going to be declining in perpetuity at 5 to 10% a year. That could happen to some companies. It's not happening to every company. I think that's where it's creating some really big opportunities here.
And so what do you think is a good median multiple then for for software company? And this is like very hard for anyone to say really, but we're at 3 to 4 right now. The question really I'm asking, I guess, is if you think things are oversold and if you expect it to come back up, where do you see them going from here?
I do, but I almost think when we get the bounce off the bottom, whenever that is, and look, cheap stocks can always get cheaper. But when there is that bounce off the bottom, I almost think it's going to be a little bit of a K-shaped recovery where some companies might bounce 20, 30% off the bottom. And I think there are other companies that could be a double or triple over the next couple of years from here. And, I mean, I'm gonna give it in very broad brushstrokes, but I almost think that the quote right multiple is maybe call it 15 to 20 times cash flow for the companies that are, the incumbents that aren't really going to be AI winners, but also aren't going anywhere. And then that number could be 30 to 40 times cash flow for companies that are going to actually be AI winners, that have innovation, that have the ability and right to get AI SKUs in the hands of customers and actually monetize that over time.
But once again, I see you prioritizing cash flow here. I mean, I see you very much talking in terms of earnings.
Yeah, and look, cash flow is what matters at the end of the day, right? And I think whenever possible, we should be valuing these companies on profitability, not on revenue. Don't get me wrong, growth is still what is most important in this world. But I think there's what we've learned, at least over the past 2 months, is if you are going to lean on margins and cash flow or earnings, you better not have egregious stock-based compensation.
Okay. And so in that K-shaped recovery then that for software, who are your winners and who are your losers?
Yeah. In that K-shaped recovery, I think HubSpot, Intuit, MongoDB, even Microsoft could be, big bounce backs off of this. HubSpot's down 60% over the past 1 year. I actually think they have a very innovative AI roadmap under CTO and co-founder Dharmesh Shah, which gives me a lot of confidence in that company. I think there are other companies like Workday, which we opened up this talking about, that could be, 20, 30% higher than where they are right now. But I don't know that that is going to be a double or a triple. I mean, we'll see what magic Anil might be able to bring back to this business, but I don't know that this is a re-accelerating growth story. And without that, I don't know that we're going to get that sort of huge bounce back that would reward the investors that are willing to step in uncertain times like this.
And who else are you worried about besides Workday?
I'm worried about Oracle. I'm worried about candidly Salesforce. I think no surprise, Salesforce, and they've made a lot of efforts with Agentforce, but those efforts haven't really gotten the level of traction I think investors have wanted to see. Obviously this is almost the year that's make or break for Agentforce. I would love to see them succeed. They're my hometown company here in San Francisco, but I just haven't seen evidence of them having that kind of innovative roadmap and big customer success out of Agentforce so far. Oracle, I think, has almost backed themselves into a corner with this large OpenAI deal, and clearly, as we saw with the debt raise, they're committed to funding this and meeting those commitments. But I don't know that Oracle is going to be retracing those highs that we saw out of them, whatever, 4 or 5 months ago.
I mean, I'm just looking at your list here. So, I mean, what about some of these? I'm thinking application layer companies, like Asana, DocuSign. You know, what do you make of those names?
Yeah, look, I think a lot of those could be in trouble, right? Like, I like some of the big application platform names like HubSpot, but
Yeah.
something like Asana or DocuSign that's maybe more of solving one or two problems are ones that maybe could face bigger AI risk, right? Asana, for example, I think it's a great product. It's a favorite tool here in Silicon Valley, But these AI note-taking apps, you think about things like Brunola and Otter, have gotten really good at not just summarizing, but turning that into actionable text. And that starts to chip away at the actual value proposition of Asana. DocuSign, obviously they're making a big efforts with IAM and these contract lifecycle management and analysis pieces. But you've seen some of that get built out of OpenAI and Anthropic. And sure, they're whatever products today, but who knows what they're going to look like in a year or two, given the rate and pace of innovation out of these. So I don't want to say these companies are necessarily in trouble, but I do have actual concerns just over that. If you're not a full robust platform, there's probably more AI risk than if you are.
Right. And as you said, a lot of this is really it's the terminal value here. It's not necessarily the near term growth prospects for the company. It's, where do they go 15, 20
That's
years?
exactly.
And as we all know, terminal value ends up being a lot of the model at the end of the day. So, uh, well, Rishi, I want to thank you for coming on. It was a great conversation. That is Rishi Jaluria from RBC Capital Markets here on TITV.